So I had a request to make a video about options. So I won't claim to be like a professional options trader, but I've been doing it and I definitely understand the concepts of it. So more or less, whenever you're buying a contract, it's always important to take into consideration the prices and the time of expiration. Because if your goal, if you're buying an option, depending on whether you're buying it out of the money or in the money, regardless of whether it's a put or a call, your goal is for it to, go deeper into the money or at least hit the money. So you definitely want to make sure you have enough time involved in that trade for that price action to happen. And so one important thing about when you're trading options is not going too far out of the money. If you're paying for some cheap options, well, there's a saying: if you pay for crap, you're getting what you pay for. So, like these options in my portfolio right now are actually a perfect example. Even though I'm fairly confident that these plays are going to play out, they are all extremely far out of the money. So this one right here, $28.60 is where the stock closed at on Friday. And I'm saying that I think this stock's going to go down to $22.50 by May 15th. So that could still play out. And I actually bought this play a while back, and I bought some more contracts. But I first opened this position April 7th, and you can see that the prices actually went down since then. I like to average down personally, but that's, depending on your trading strategy. But the main important part when you're trading options is, from my experience, is definitely giving yourself enough time. That's like the most important factor. And also, another thing is you want to watch the premiums, because sometimes premiums will shoot up on stocks, just because they're moving a lot more than they typically would. Like, let me try and find a good example here. A stock that's had a good, up day, their options are going to be much more expensive than if that stock has been trading sideways. So just keep in mind that the option prices will change. It's not only to do with time. If a stock is trading sideways, your option is going to depreciate in value, because whenever you're buying these contracts, people are expecting a certain price action. So if you're saying, I'm not finding a good example on the stock here, but we'll use Alibaba as an example. Okay, so, I have the 192.50 puts, extremely far out of the money. I bought it whenever it was around $203. Okay, but the thing is if you bought this option right at the beginning of the day, it would have been, quite a bit cheaper. Not only because of the price action, but because, the price went down. Okay, that being said, now if you bought a put right here at the bottom of that whole little sell-off period right there. Say you bought that put right there, and then you held it throughout the end of the day. Regardless of what you paid for that option, even if you paid $60, since the stock traded sideways all day, the price action that people are anticipating is going to go down. So that means people are not anticipating as big of a move as they were whenever it was falling fast. So as we see, when the price was falling fast, the options, there's no way for me to really show that to you at this point. But if we go back to my option chart, you'll be able to see the correlation actually. See how it peaked, and then, it just kind of went sideways for the rest of the day. My option did, and it actually went down. You can see not only did it go sideways, my option went down with the day, even though the price of the stock was trading sideways. So that's one thing you want to keep your eye on. And just because the stock's trading sideways and your option's going down, I would strongly encourage you, if you're buying options and trying to flip premium, once you buy that option, can write it off as a loss. Basically, you're buying a lottery ticket, more or less. There's been so many situations to where I have actually bought into a position and I started losing pretty badly. So I wanted to get out of that position because I felt like the trade was no longer going to go in my direction. So I ended up getting out of that contract, and lo and behold, the day before expiration or the day of expiration, huge price action happens, and I would have actually ended up making a ton of money. So that's one thing, if you are trading options, do know that the time effect is going to bring down the value. But then also, so is the sideways activity. But as soon as that price action breaks out, whether it's to the upside or to the downside, the price anticipation that people are expecting is going to go up. So the premium prices on those options is automatically going to go up just because people are expecting a bigger move. So that's really what trading options is all about, is being able to anticipate the next move and giving yourself the proper time period for them options to happen. And options are 100% more risky than trading stocks, because a stock you only lose a percentage. It doesn't expire. Options expire. They can expire worthless. This week I had $600 in options expire completely worthless. Last week I had about $500 in options expire completely worthless. But I'm not even worried about that, because really I'm actually still up. Even though I've lost, I'm actually still up because I've pulled out pretty much all of the money that I've deposited. So basically, I'm playing on house money right now. So I'm making some risky trades that have a high risk to reward ratio. And that's really what it's all about, is understanding the risk to reward ratio. If you're risking $50 on an extremely far out of the money play, how much are you expecting to make off of that? If you're only looking to make about $75, take your 50 into 75, it's not really worth the risk. But if you have reason to believe that, say, this stock is going to shoot up from, say, $20 to, say, $28 or whatever, $30, and you buy an out-of-the-money option, well, that could be a very good opportunity. But just realize that the less time you give yourself, the less chances you have of really hitting that mark. So that's the most important thing that I've really been trying to, break myself the habit of. I'm guilty of seeing these cheap prices that expire in 2 weeks, and I go ahead and get in, and then the move actually takes 3 weeks to develop. So where if I would have gave myself that little bit of extra time, I would have hit that option right on the head, came out a winner, and made a good amount of money. But I didn't give myself enough time. So I'm now trying to give myself a month worth of time on any options that I purchase, unless there's an option that I see on the weekend, or not on the weekend, but an option that I see that is at a real cheap price, but I see that it's about to make a movement. So when it comes to like the theta and delta and these little statistics, the gamma, I don't mess with any of that. I don't know about it, and I don't really, in my trading style, it's not necessary to know that. I basically trade the options like I trade stocks, and that's just the way I look at it. And the only difference is you can lose 100% of your investment trading options. So just keep that in mind. And I'll definitely try to make some more videos when the actual market is live, and I'll do some live trading here soon. I know that this may not be the best video for teaching the basics of options, but I'm trying to explain basically how you want to play with options and the risk and the reward, because hey, there's been times where I bought an option for $40 and ended up selling that exact same option for $400 just a couple of days later. So big, crazy things can happen, but you can also lose 100% of your investment if you just go buying random options without having an idea of what you're getting into. So you just need to know what you're getting into, know the time period, know the price action, analyze your situation, think about it, and evaluate it before you take the trade, because once you take the trade, you're in. And that's the way that you should do it, in my opinion, is if you're trading options, once you buy that option, just let it set. Don't sell it just because it goes down by 20, 30, 40, 50%, because that option could turn around. That's just my opinion. That's the way I'm doing it, because yes, losing money sucks, but I'll tell you one thing that sucks even more is taking a loss on something that you would have turned a profit on if you would have just been patient. So that's why whenever I understand the risks of trading options, and that risk is, if I am wrong, I will lose 100% of my money. But if I'm right, I will make several 100% on my money. So that's why I'm just going to let my options expire. If I'm wrong, I already counted that loss into the beginning of the trade. So as soon as I made that trade, in my mind, I told myself, okay, I lost it. But if that option comes up, you know, that's going to save me. And so with that being said, I hope that this all made sense to you. And maybe I'll do a live stream within the next couple of days if anybody has any questions, and we can just kind of like talk about it. And I can explain a little bit more about a specific question. This was more like a general video. So yeah, if anybody has any specific questions, go ahead and leave it in the comments below, and I'll do my best to get you that answer. So anyways, guys, y'all have a great weekend, and stay safe out there, okay?